At a moment when global markets seem to be drifting into uncharted waters and policymakers scramble to hold the financial architecture together, it's worth taking a closer look at what Bessent believes could be the last workable blueprint to stabilize the Treasury market before things get truly out of hand. As you can imagine, the situation isn't just fragile, it's deteriorating in ways that even seasoned analysts didn't expect. Right now, the U.S. economy is being propped up by essentially two major pillars, and both are under significant pressure, especially with exports slumping. The first pillar is the massive wave of AI-related capital. Global investors are still pouring money into U.S. tech and AI infrastructure, essentially treating America like the global epicenter of the future digital economy. The second pillar is the U.S. bond market, but despite deteriorating economic signals, red cards, ugly jobs numbers, all hinting at an impending recession, Treasury demand, especially for long-dated bonds, remains disturbingly weak. The recent 30-year auction made this painfully clear. Bessent attempted to offload $25 billion in 30-year bonds, and the outcome wasn't pretty. We saw the second consecutive tail, signaling that investors simply weren't willing to lock themselves into holding U.S. debt for the next 3 decades. And honestly, who could blame them under today's conditions? As a result, the Treasury had to sweeten the deal by offering a higher yield. Since 2020, investors have repeatedly forced the U.S. to raise yields to attract buyers because the country's borrowing appetite has ballooned to uncomfortable levels, even for a reserve currency issuer. Bessent understands that a reckoning is coming, especially as he is simultaneously waging a global trade war that ironically cranks up global dollar demand while worsening the underlying fiscal imbalance. Meanwhile, Trump refuses to slow spending. If you're inflating an AI mega bubble and trying to rebuild supply chains domestically, you end up burning through mountains of cash. Tariff revenues don't come close to offsetting the explosion in federal outlays. Just look at October. The Treasury reported a staggering $284 billion deficit, the worst opening month ever recorded. This isn't a tariff issue, it's a fiscal crisis. Government spending surged 18% to nearly $690 billion, and the interest expense alone hit $14 billion in that single month, which annualizes to about $1.2 trillion per year. That's why central banks have been quietly shrinking their Treasury exposure on a percentage basis. The numbers are going vertical, and 2026 is expected to be even more chaotic with the incoming Fed chair. The deficit is effectively uncontrollable. Trump is preparing to install another loyalist at the Fed, someone aligned with his urgency to slam interest rates downward because the deficit-driven interest burden has become the most dangerous, least talked about crisis in the system. Interest payments already exceed U.S. defense spending and even healthcare expenditures. At this trajectory, interest will soon outweigh Social Security obligations. The math is brutal, and it explains why Trump is so determined to force rate cuts. Without them, the U.S. would spiral into a cycle of borrowing more money simply to pay interest on existing debt, which would erode market confidence and cannibalize funding for essential domestic programs. This brings us to Bessent's grand idea, his so-called financial escape hatch, stablecoins as the future engine of Treasury demand. It's his last-ditch effort to channel global dollar appetite into U.S. government debt. As he put it, the administration is gearing up to deeply integrate stablecoins into the structure of U.S. dollar dominance strategy. The pitch is straightforward. Smaller nations with weaker currencies should increasingly rely on dollar-backed stablecoins, essentially bypassing traditional U.S. banking systems. People could simply buy a dollar-pegged crypto token that settles globally without barriers. But then the narrative drifts into fantasy. Bessent claims stablecoin demand could exceed $3 trillion globally by 2030, with all that liquidity supposedly cycling into short-term T-bills. This becomes his justification for issuing more short-dated debt while avoiding long-term issuance that could wreck the U.S. economy through punishingly high yields. The stablecoin pipeline becomes the excuse to reassure markets that new demand is coming, even though the evidence says otherwise. Right now, there are two dominant dollar-pegged stablecoins, USDT, Tether, and USDC. Tether's market cap is nearly triple USDC's, but combined they're only around $200 billion. How is that supposed to magically become $3 trillion? Worse, the assumption that stablecoin issuers will buy treasuries for backing is flawed. In reality, issuers like Tether have been buying gold, massive amounts of it. Last quarter, Tether purchased more gold than any central bank in the world, even more than China's official purchases and more than Brazil's entire intake. 26 tons of gold, roughly $3.2 billion worth, represents about 2% of global supply. They're not buying T-bills with that money. They are buying physical gold bullion. So Bessent's thesis that stable coins will become a structural engine of Treasury demand is shaky at best. Yes, in theory, stablecoins should hold short-term bonds for redemption liquidity, since locking up reserves in 10-year notes would expose them to dangerous volatility. The Genius Act might eventually force issuers to back tokens strictly with T-bills, but there's a reason Tether wants diversification. The dollar loses value, and companies want better returns. Counting on stablecoins for structural Treasury demand is risky because unlike central banks, pension funds, or commercial banks, stablecoin issuers are not locked-in buyers. And if they all follow the same conservative model, the only competition left is transaction fees a race to the bottom, so naturally they chase yield elsewhere, replicating Wall Street speculation in digital form. Recently, S&P downgraded its assessment of Tether's asset quality from constrained to weak because roughly 24% of reserves are allocated to higher-risk assets like corporate bonds, Bitcoin, secured loans, and gold. From Tether's perspective, they must diversify to generate returns, otherwise they become nothing more than a transactional utility with shrinking margins, but that opens up major cracks in Bessent's plan. If a liquidity crunch hits, stablecoins will dump their treasuries first because those are the most liquid assets, leaving the question of what happens after that. Pension funds and insurance companies don't panic sell treasuries due to lock-in structures, but stablecoin users have zero loyalty to debt markets. Luke Geeman recently destroyed Bessent's timeline analysis by pointing out that stablecoins have only grown about $10 billion per month since the Genius Act began. At that pace, it would take 23 years to reach Bessent's $3 trillion goal. And in 23 years, U.S. deficits could easily reach $6 trillion annually. Borrowing isn't slowing, it's accelerating into a universal constant. Now, shifting from the Treasury market to the U.S., China dynamic, things get even stranger. The Wall Street Journal reported that during a call between Trump and Xi, Trump supposedly told Japan to behave and lower tensions over Taiwan, effectively urging Tokyo to stop aggravating China. If true, this would humiliate Japan diplomatically by exposing how little autonomy it has. Japan denies the report, of course, but someone is lying. If the U.S. really told Japan to dial it back, Beijing clearly holds leverage behind the scenes, and the U.S. may be on weaker footing than many assumed. Trump, for his part, emphasized that Xi promised to buy more U.S. farm goods and that he expects pleasant surprises. He also announced that he'll visit China in April 2026, signaling a notable shift. Washington is moving toward Beijing, not the other way around. Part of this is political theater, sure, but beneath the optics, the U.S. needs China's cooperation to prevent an economic implosion, especially to keep the AI bubble from detonating prematurely. Even American Christmas shopping is being distorted by tariffs. The effective tariff on toys soared from 0% to 22%, yet China still supplies 67% of U.S. toy imports. So Americans are paying inflated prices for toys this December, essentially subsidizing U.S. data centers. It's both absurd and revealing. China remains embedded in U.S. supply chains. There is no realistic replacement in the near term. And then there's the critical rare earths issue. U.S. supply chains are so broken that Washington is desperately urging countries to side with the West. The ambassador even admitted that while BRICS may offer Malaysia some benefits, Malaysia's long-term prosperity relies on Western integration. Meanwhile, the U.S. must secure rare earths for magnets, but China dominates, refining roughly 90% or more. Trump still has to rely on China for industrial inputs, but China's wary. Why help the U.S. build weapons that could one day be used against them? So Beijing crafted a clever solution: honor export commitments in theory, but impose strict constraints using the validated end-user VU system to prevent rare earth magnets from reaching U.S. military suppliers, defense contractors, aerospace firms, even automotive companies with defense clients could find themselves unable to secure imports. Bessent said he hoped approvals would come by Thanksgiving, but Thanksgiving has passed with no sign of progress. This may explain why Trump now feels compelled to personally travel to China. The Chinese could make concessions, but they will demand something enormous in return. Nothing in geopolitics is free. So the questions remain. Can Bessent really extract $3 trillion from the stablecoin market? And will Trump's upcoming trip to China produce anything meaningful? Share your thoughts in the comments below. Stay safe, hit the like button, and subscribe as we try to make sense of these surreal times.